we're going to start moving into credits. And the first credit that we're going to be dealing with is the credit for child and dependent care expenses. I really don't want you to confuse this one with the child tax credit, which we're going to cover in a couple weeks. So just what you would imagine that this credit does is if there are expenses to care for your child, you can allow some of that, partial amount of that, up to $6,000 for 2 children and $3,000 for 1 child as a non-refundable credit. All right, so let's talk first about a non-refundable credit. Notice that there's 2 different types of credits, and I included that in the Blackboard course. A non-refundable credit is generally are applied against tax in the order they are listed, meaning that you cannot get a refund for it. They are non-refundable. The only thing that they can do is reduce the amount of tax liability that a taxpayer has. And this credit, the Child Independent Tax Credit, is just for that. It is a non-refundable credit. So if you have a tax liability of $800 and your credit for this comes out to be $1,000, you are not going to get the extra $200 back. Your tax liability will just be 0. It will reduce it down to 0. So the credit can be claimed by a taxpayer with 1, a qualifying dependent, and 2, work-related dependent care expenses. We'll talk about that back here with the eligibility test. And this credit can range anywhere between 20 and 35%, and that depends upon the adjusted gross income. This changes a lot, of course, like every other one, but right now, I think that it is 200,000 AGI for single, and mostly it's claimed by married anyways, except for special circumstances, is $400,000 limit income. So in other words, if you make more than $400,000 as a married couple, you would not qualify for this credit. My point is not to know the number specifically every year. My point is to recognize that it's an incredibly high adjusted gross income. So most people that have caregivers, whether it be daycare or somebody within their home, qualify for this credit. It's not like an earned income credit or a child tax credit, which we'll be learning about, which are geared more towards lower income AGIs. Notice that sometimes there's employer provided dependent care benefits, and that would show up in box 10 of your W-2. So how do we determine the taxpayer eligibility? There's 5 tests that we're going to talk about. That it has to be a qualifying person, earned income, and so on. You can read there. The qualifying person test, and these tests for eligibility person, and I'm looking right at it here, are on in your textbook, page 1, and right at the top there, it identifies who a qualifying person is. The first one here, it listed that they are under the age of 13 when the expenses were incurred. So in other words, if somebody is 14 or above and they still have a caregiver, it does, unfortunately, you can pay for that, but the government feels they are capable of being left by themselves, right? If a tax payer has a child that turns 14 in the middle of a tax year, which is obviously happens probably a lot, the percentage of expenses while they were 13 versus 14 would qualify there. Notice here it also identifies people that are incapable of self-care, and it also determines what self-care is. You cannot dress yourself, eat yourself, and things like that. Common everyday functions. So that also applies here. They can be claimed. Notice that any person who was incapable of self-care, whom the taxpayer can claim as a dependent or could have been claimed as a dependent, qualify. That person cannot have income more than 4,200. We covered dependents way back when, right? So now that's coming into play here again. So somebody that's incapable of caring for themselves, whether that be a cousin or a mother or a father, whomever there. And then it also includes, notice the last bullet point, there is the spouse. The earned income test here, and gives you that earned income table. Generally speaking, with the earned income test, because child and dependent care expenses are used to pay for child care while you are either looking for work or at work, you have to have some type of earned income. So in other words, if you have unemployment, well, unemployment's a bad, well, let's use unemployment. Let's say you have unemployment and you're receiving unemployment benefits which are not earned income. You go to search for a job on Monday and Thursday, you go to interviews, but your child is in daycare Monday through Friday. That's going to cause a problem, right? Because this credit allows you to take the credit for while you are actively looking for work, you would only be able to deduct those expenses, use those expenses to lead to this credit on the Monday and the Thursday, not for the other 3 days, just because you needed a break as a parent. Notice that there's work-related expenses. There's a limit on the work-related expenses, which is $3,000 for one person or $6,000 for two or more qualifying persons. This is important in that the fact that if you have two or more qualifying persons, the limit still can apply even if the first person had zero expenses. So say, for example, you have two children. One is watched, child number one is watched by your mother, and child number two goes to daycare. Even if you have two children and the first one does not qualify because you probably aren't paying for that child care, right? And we'll get to the provider identification number at the bottom, which your mother probably doesn't have. That second child can still gobble up the entire $6,000. So it's not per person, not per dependent, it's in total, $3,000 for one or $6,000 for two. But when you get to the two, it's not per person. Notice that there's a joint return test. Generally, married couples must file a joint return to claim the credit. There are exceptions, and those exceptions, which I'm not going to get into, are in your textbook in the section here somewhere. We're not going to cover that in great detail. The last one here is pretty important. Notice that the provider identification test comes into play. You have to provide the care provider's name, address, and EIN number or TIN number is required. In other words, if your mother is accepting money for her services, but she doesn't want to claim that income, this right here on the bottom, but you want to take the credit, it's not going to work. And this is why, because what this identification number does is then cross references to the person that should be receiving the money. So if you take the credit and identify someone that you are paying, then on the flip side, that person should be recognizing that revenue. So if that person that you are paying does not want to give you their supporting information, obviously you'd have their address and things like that, but their TIN number, then you cannot take the child dependent care credit. Determining the amount of income, there's three parts to Form 2441. The first one is the general information about the care provider. Part two is where the child expenses is calculated in that section. And number three is deals with employer provided dependent care benefits. So if the organization you're working for has provided an amount in box 10, you'll have to take that into consideration. Really, these, in my opinion, are out of order. Part one, should be completed first, then part 3, and part 2 lastly, because part 3 plays a part in part 2. Make sure you double check all of your entries, obviously. And there's a little bit of a summary there. So again, read up on your textbook starting, I think it's in section G there. That'll give you some supporting information, but I'm sure some of us will be dealing with this type of credit in VITA.